Okay, hello and welcome to video 1 of the Serene Basic Options Pack. Now keep in mind, the focus of this whole video series is to really just get you a solid foundation in basic options. As an options trader, there's a lot of different opportunities that you have to trade, and obviously as you get more advanced in trading options, you can take these options, calls and puts, put them together and actually create multiple types of strategies around one specific stock. And these are called spreads or non-directional trading. Now, we're not going to get into that in these video series. Number one, because it's not something I do that often. It is something that some people like to do. However, I like to chase the momentum stocks, to find the momentum stocks and to ride that momentum stock with leverage, and that's the way that I make the money. So a lot of the people out there understand this style of trading, which is momentum trading, and that's really what we're going to do. So there's multiple ways to trade, and just use this as a foundation. If you decide at some point you want to go into spreads, straddles, condors, things like that that are a little bit more complicated, then we can direct you in that path. But right now, what we want to do is get your foundation built very strong with basic options. So you have a study guide, and the study guide is really put together for you to read kind of separately from the video series, because what I want you to do is really pay attention to the video. If you're following the guide, then you're not really going to pay attention. My suggestion would be, after the first video, you read the first section of the guide. Now you're going to find that I've added more information throughout this video series than is actually in your guide, and that's specifically just because I wanted to give some more content. When I put the study guide together, I thought it was valuable, but I will add more information around that because I think it's important that you continue to have more information given to you, but not without purpose. You're going to have this information given to you, but it's going to be effective, and it's going to be things that you really need to know, things from my experience and my background that I think will be beneficial to you. So without further ado, let's go ahead and get started on video 1 of the Basic Options Package. Of course, we always have our required government disclaimer and risk warning. So I encourage you to pause the video right now and read this and make sure you understand there is risk involved with trading any type of financial instrument, especially one using leverage. Okay, so hopefully you have that out of the way. Let's get into it. Stocks versus options. You know, when I learned how to trade the stock market, I really first learned by watching, the news channel. And back then they didn't have CNBC. They had the Nightly Business Report, which was on a public broadcasting network. And I would see these stocks and these ticker symbols of these codes going across the bottom of the TV. And to me, it looked very complicated. It looked like some type of a mathematical language, and I knew that I was not a mathematical type person. So I never thought I really would be involved in the stock market. I remember when Netscape went public, and I had a roommate at that time that was sharing my house with me, and he made some really good money on Netscape. How he got in it, I don't know, but that was the story. And when I saw what Netscape did, I was amazed to watch that stock rocket. And in a matter of a couple of years, I found myself getting involved more and more in the stock market. But my first background in the stock market came with working at a corporation, MCI Telecommunications, and I was given stock, and I started to make some money, and I would take a little bit of that money, and then I went out and I started a savings account, and I took about $1,000, and I invested with no background. One thing I wanted to invest in was this multi-level company called Startronics. Well, Startronics had this brand new technology, which was a telephone and a computer hooked together. Remember, this is when the internet was new, and I wanted to buy them because I thought that was the neatest technology ever. So I went down to my broker, which at that time was a actual building, and I told them I want to put $1,000 into the account here, and I want to buy Startronics, which was a penny stock. And the broker tried to move me, if I wanted that technology, into this company that was not really known yet, but was really doing well, called Sun Microsystems. And being such a genius in my early days, I decided against it. I didn't know who Sun Microsystems were. They told me they created this technology called Java. Well, I didn't know what that was. I had no interest. I wanted my Startronics. And unfortunately, I put it in Startronics, which became a penny stock. Well, it already was, but I lost everything. Looking at Sun Microsystems, that $1,000, had I held on to that $1,000, would have turned into over $100,000, I believe, is what I looked at. So I was really off base, and the broker actually did some good work there by advising me to get in a stock that was new and yet taking market share in this whole new area of technology with Java. So that was the way I learned, first through hard experience, through losing money. And eventually in 1996, I decided I needed to get trained, and I went after a course of training. I invested a lot of money, which I didn't have, but I kept investing in myself, going to trainings, reading books, home study courses, and over time spent over $100,000. So what I'm going to share with you is really this. I have learned in about 15 to 20 years of trading that there's a lot of stuff out there, tremendous amounts of information. And the more information you get does not make you more successful. In fact, it can cost you money. My slogan now is the more I learned, the less I earned. And the reason for that is because you tend to get frustrated, you get confused, you have too much information, too much analysis, and little action. It's better to have a narrow focus, to find what resonates with you, to get good at it, and to focus on that with discipline. Put blinders on to everything else until you've mastered one area. So with basic options, I would suggest that's what you do. And after you get really good at basic options and making money, if you want to branch out into spreads and straddle, that's great. Go ahead. But I don't suggest you do that until you're a master of the basics, because you cannot build a building without a solid foundation. And the basic options is the solid foundation. Now, one more thing I want to say is make sure that if you are new and do not have an understanding of stocks and technical analysis, you want to start there first, because you don't want to learn options when you really don't understand charting, technical analysis, fundamentals, and equity, because stocks are the underlying for the asset of options. So you got to understand stocks. Now, if you purchase this course and you do not understand stocks, just contact us. We have another program that will get you set up on understanding technical analysis, very simple, fundamentals, and also stocks, how to trade those. Then that will go hand in hand like a hand in glove with the options course, okay? So if you got ahead of yourself, it's not a problem. You want to get that foundation first, okay? Because you need to understand stocks. And I do recommend people trade stocks for a while before they get into options. But I'm going to tell you this, I did trade stocks for a little while, not very effectively, and then I started to trade something called a channeling stock, made some money, and when I saw options and the ability to put less money in and make a lot of money, I wanted options, so I went right into options, probably before I should have. But I'm going to build a foundation for you in options that will get you into options much quicker, so that you don't have to take that long road down the stock highway. So I, again, suggest you first learn how to trade with stocks and technical analysis, and just go to sereneinvestor.com or send us an email at support@sereneinvestor.com or me personally, Vince@sereneinvestor.com, and I'll get you set up to understand what you need to get that foundation on stocks and technical analysis. Okay, let's talk about the long and the short of it. If you're new to the market, a long means you own something. So if you ever hear somebody say, I'm long stock or I'm long options, that just means they own it. Why they call it long, I don't know. I don't know why they don't just say, I own stock. Make it simple. But in the stock market, they use a lot of terminology that tends to confuse people, and it doesn't have to. Just keep in mind, long means you own it, and short means you owe something. So if I'm short an option, that means I sold it. I sold it and I'm short. Okay, if I'm short a stock, I sold it and I'm short the stock. Okay, so just keep in mind, when you go long, you're buying. When you go short, you're selling. We're going to focus on buying a lot more, because that is the way I make money, and that's the way, as a momentum trader, you're going to make money. And then later, after you get good at buying options, you can learn to sell options. And when you sell options, you can change probabilities. There's certain times and certain strategies that you will use for buying or selling. So we're going to focus pretty much on buying. You're going to understand basic calls and puts so that you can make money and do well. And then we'll move down that road for shorting, etc. Here's some of the terminology you're going to learn. Strike price. We're going to talk about that. Expiration date. Again, think of milk. It's going to expire at some point down the road. So with options, you're going to want to ensure that you move the option before it expires. And the strike price, I'm going to give you a great example on that here in a little on one of the next videos. And then contract. Remember, options trade in contracts. If you buy stock, that trades in shares. So a contract in the options arena controls a certain number of shares. In this case, it's 100 shares on the U.S. markets. If you're in a different country and you're trading that, it could be 1,000 shares, which is typical. But in the U.S., it's much, much better, more liquid, and we break it down to 100 shares so that it does not cost you as much money. So one contract is 100. Open interest. Well, that basically tells you how many open contracts there are in that option position, because you want to make sure there's enough liquidity. If you're in an option position and there's no open interest and you're the only one, you don't have anybody to sell to or to buy from. So you want to make sure you have good open interest. 100, 200, thousands is better, and that's where we're looking. As a new trader, though, you probably don't need thousands, simply because you're probably going to be trading 2, 3, 5, 10 contracts at a time and not 50, 1,000, which the big boys do. Then we have symbols. Options have symbols. So the stock ticker symbol would be like Starbucks. Starbucks is SBUX. If you're going to trade Starbucks, you're going to trade SBUX. That's the ticker symbol you see go across the screen on CNBC or Bloomberg. Options have symbols as well. They're not the same as the stock. And this all just changed here in the last couple of weeks, and they have totally changed the symbology on the options. And you don't really need to know that. Your broker will have that handled. And if you really want to know it, it's extra stuff you don't need to know to make you money. But just check out your broker's account and they'll explain it to you. Now, I'll share with you brokers at the end of the video series, the one I use, and there's several of them out there that will give you a good ability to trade from your home or from your iPhone or from any of that type of technology, so you can really be free to travel around the world and trade the markets. Premium is how much you pay or are paid for an option. So if I buy a Starbucks option, I'm going to pay a certain amount of money for that option. And it could range from a very small amount of money to a very great deal of money depending on the option itself and the strike price. And there's other components that we'll look at that will determine the price of that premium. Now, if you're a seller of options, you're going to get paid that premium by the options buyer. So remember, there's two sides of the trade. There's always a buyer and a seller. It's just like the real life market. There's a buyer and a seller, and that's what we're going to look at. And then the options chain. The options chain really is just the series of options you can choose from. Remember, when options are written on a stock, you don't get to make up your own option. They are already written by the market makers, and the option will have a series of choices in a series of months. So it'll have all kinds of different strike prices and several different months to choose from. So you decide what strike price in what month, and then you're putting this plan together. And you'll understand all this. I know it's a lot of stuff, but keep in mind, we're going to go through this chunk by chunk. You do it a little bit at a time, you work through it, and then we'll go from there. So that's the way you want to do it. Okay, control versus ownership. I learned in my early years, after I grew up basically broke, and I met a very wealthy gentleman in Nebraska when I was stationed in the Air Force out there, and I learned from him that wealthy people want control versus ownership. Control is critical because when you control something, you don't have the liability, and that's what we're looking for in regard to the options markets. We don't care about ownership. That's what shareholders want. We want the control. So stock, if you're buying stock, equals ownership. You're going to own it. So if you buy 100 shares of Starbucks today, well, you now have a stake in the company. You own a fractional amount of this great company called Starbucks. And the thing about that is you get voting rights. You can vote on certain things that come up. You can go to the meetings. And if they have a dividend, you get paid that dividend. So that's the benefit of ownership. However, when you look at option trading, it's going to be quite different. With options, by the way, let me just share this with you. This is Amazon up in Seattle. When they first started out, as a smaller company, and you could have bought stock there, for very cheap. And then they grew over time. So as the company grows and the stock goes up in value because the company is gaining market share, it moves into bigger buildings. It takes, a lot more to run the company, but there's a lot more earnings coming in. You have part of that ownership. So keep that in mind. That is owning a stock. Options are control versus ownership. Again, one contract equals 100 shares of stock. There is no such thing as a half a contract to control 50 shares. Okay, there's one contract that controls 100 shares, 2 controls 200, 10, 1,000. So anytime you look at an option position, it will be quoted at a premium. Let's say it costs $2.50. Well, they're going to quote that per share. So $2.50 per share is how much it's going to cost you. So you always got to multiply that by the number of contracts. If I have one contract, well, that means I got to multiply my $2.50 that the option cost by 100 shares. So it would cost me $250 to buy one contract. But with that one contract, I control 100 shares of stock. Okay, instead of paying a large amount for the actual shares, I'm going to pay a fractional amount, control it with an option. I can choose to buy 1, 2, 5, or 10. In the beginning, you might not have a lot of money to put into 10 contracts. I didn't. In fact, when I started, I didn't have enough money to buy 10 contracts. So what I would do is I would buy more time, and I would buy one contract and look for the stock to move up in value over time. And that's really what happened with me. And that made me a lot of money. So I'm going to teach you that. That will actually be a bonus that I'm going to give you. So watch for that. It's called leaps. It's not going to be in this video series, but I will give it to you. So watch for the leaps. Now, keep in mind, when you do own options contracts, you don't have ownership. So there's no voting and there's no dividends paid to you. You just are controlling the price of the stock, and that's all you're doing. Okay? So you're giving up some areas of benefit for some other areas of benefit that we'll talk about. So the stock market, if you're buying a stock, you're always going to trade at a bid-ask. So anytime you see a stock quoted, it's going to be quoted at a bid-ask. Same with the options market. It's a bid-ask spread. So think of it like this in the retail market. If you go to Walmart and you buy something, you're buying it at what? Retail or wholesale? You're buying it at retail. So it's marked up by the time you buy it. You don't get to buy it at wholesale. So same in the market. You're going to buy at the highest price. The stock or the option, the market maker is going to charge you the higher price. The lower price in the bid-ask spread is really what you can sell it at. So the bid-ask spread, the stock might look like this. If you see a stock quoted, it'll be 25 by 25.50. Now, if you buy it right now, you buy it for $25.50, and if you immediately wanted to sell that stock, you're going to get 25 for it. Where does that 50 cents go? Well, we're going to talk about that. Okay, but just keep in mind, you're buying at the higher price. You're buying at the higher price here, and you're going to sell at the lower price. Now, this is called the spread, the difference between the two. The difference between these two, 25 and 25.50, is a 50-cent spread. Where does that money go? Well, that money goes to the floor trader, to the market maker, to the one who's actually creating the fair and orderly market. For them to stand on the floor and make a market for this stock, they're going to take their spread. So if you have 1,000 shares of stock you're buying for $25.50, well, they're going to make 50 cents per share, which is going to be their chunk. It costs a lot of money to be down on that floor, hundreds of thousands of dollars, and they got to pay that every year in addition to make money for themselves. So they're going to get the spread. Okay, so keep that in mind. They make the spread every time, and you're always buying at the ask and selling at the bid. So obviously, I want this stock to move up at least 50 cents or enough to cover my spread, so if I sell it, I break even. Now, I'm getting in the stock because I expect it's going to go higher than that, but that's what we need to do to break even, is make sure it moves up enough to cover our spread. If it doesn't, we're going to take a loss in what they call the slippage. And if we can get that spread closer together, that's better. If the spread is 25.25 compared to 25.50, well, then we only have a 25-cent difference between the bid and the ask. So we want tight spreads. The tighter, the better. And by the way, the more tight the spread, the more liquid the stock or the option. So keep in mind, if stocks are not as liquid, they're going to have bigger spreads, or the market maker's not going to take as much risk. They're going to pass that on to you. Okay, so keep that in mind. Tighter the spreads, the better. Bigger the spreads, the less liquid. It does not mean you can't trade stocks with bigger spreads. I do, if I know something about it, or if there's a purpose behind why I'm doing that. But I also know going in that I have to make up that spread. So if I have $1 spread or a $1.50 spread, I know that stock has to move $1.50 before I even break even. I'd rather have it move 2 cents to make that spread tight so that I don't have so much risk in the trade. And here's the market maker on the floor. They're the ones that are taking that spread and making that money. So the bid-ask spread on options, let's say that the option on that stock is trading for $2.50 by 3. Well, same thing. You're buying the option at $3. But remember, you got to multiply that by the share. So it's really $3 per share you're paying, which would be $300 for one contract or 100-share control. If you buy 10 contracts, you're going to control 1,000 shares for $3,000. Now, that's going to be amazing because the stock itself, to buy 1,000 shares, well, in the last example, $25.50 stock, if you bought 1,000 shares of that's going to cost you $25,500. Most people don't have that money. I didn't. When I started trading, I was broke. I worked 3 jobs to pull money together. But I did have $300. And that's what was the allure of options to me, is I could use a little bit and make a lot. So in this case, you pay $3. There's still a bid-ask spread. Again, it goes to the market maker or the order book or the specialist on the floor of the exchange. But keep in mind, that's just part of doing business, okay? The cost of doing business. So $2.50 by 3. Again, we want to get the spread tight as we can. That's one of the key things to look for. So note this down in your notes here. And you, by the way, you should have a pen and a notepad just for special notes. You can always watch this again, and I encourage you to do so. But you want to make sure you try to get tight spreads on your options. It's going to give you a better scenario in regard to your trading so that you have less risk in the slippage. Okay, so the option's $2.50 by 3. One contract, again, is $3 times 100 shares, because we have one contract, or $300. 10 contracts is $3,000. And you can buy as many as you want to. So leverage is the key to wealth. You know, leverage is the key. In the United States, we've been taught to use leverage from the time we were in college. In fact, the credit card companies have been very good at teaching people to use leverage, but they've taught people to use it in a wrong way. So many people are broke, they're deeply in debt, and they owe the credit card companies. So many kids are coming out of college deep in debt, and they'll never be able to pay it back. But the credit card companies are feeding them this credit, and it's leverage. So basically, there's leverage being used by the institutions, by the banks, etc. They are leveraging other people's money. That's what we want to do. But if you learn to use leverage properly, it can make you a lot of money. Archimedes, a great mathematician from the past, said, "Give me a lever long enough and a place to stand, and I can move the earth." And again, that's the power of leverage. When you learn to use it as a proper tool in your arsenal, it'll make you a lot of money. But if you use it wrong, for example, in the most recent real estate collapse, 2008, a lot of people are wiped out because they over-leveraged. They went in and bought 5, 10, 15 houses, and they didn't put up any money. They used other people's money, in this case, the bank's money. And then when the credit crisis hit, then those houses were worth less money. They couldn't get rent on them. They couldn't make the mortgage payments. And what happens? A housing collapse. And these people are wiped out. Wiped out. So that's over leverage, and if you get over leveraged, you can get wiped out very, very quickly with the change in the market. You never, ever want to get over leveraged. We're going to teach you how to use it, but we're going to teach you how to use it responsibly so that you make money, that you manage your risk, and you get upside potential. High return, low risk is the key. So if you're looking at the options market, one contract is equal to 100 shares of stock. If it costs 50 cents for this option, you got to remember to multiply it by the 100, so it's $50 total cost. Again, you have the commission you're going to have to pay to the broker, but I'm going to leave that out of this simply because it's small, it's part of doing business, it's just part of what you're going to do every day that you trade. If you buy 3 contracts, it's 300 times 50 cents or 150, and if you buy 10 contracts, it's 1,000 shares or 50 cents by 500. So it's $500 to own 1,000 shares control of that stock. So just always remember, one contract equals 100, and there can be an exception to this in stock splits. Sometimes when a stock splits, like a 3-for-2 stock split, or different ratios of splits, it can change the contract. It's not the norm, but it does happen. So there's exceptions to every rule. And if you see a stock split and the option might contain less shares or something, those are exceptions. So if that happens, check with the broker. The broker will adjust the options and they'll share with you what the actual ratio is on the split and how that affects your option contract. So in other markets, like I said, around the world, in Europe, etc., if they trade options, a lot of their options are 1,000 share control. We're going to trade American-style options. American-style options mean you can exercise the option anytime on or before the expiration date. So you can sell it, buy it, or exercise it on or before the expiration. European options mean that you only can exercise it on the expiration date, so it's limited. So we're going to stay with American style, and this will make more sense to you later as we get deeper into options. So there's only two types of options. There's the call and the put. Now, a call is the right to buy something. The call is the right to buy something. The put is the right to sell something. So if I buy a call, I have bought the right to buy a stock. If I buy a put, I have bought the right to sell a stock. So let me show you. Just remember the telephone. If I'm going to call, I want the stock to go up. Okay, so think of calling somebody up on the phone. If you're buying call options, you are bullish on the market, which means you think the market's going up. Now remember, bullish, bulls strike with their horns and they strike upward motion. So that's a bull market, is the stock going up. Now if you buy a call option, you're expecting upward movement in the stock. You expect it's going to go up in value, and then you're going to be profitable because you're buying the right to buy it at a lower price and can sell it at a higher price. So let's take this example. Let's say you go out today and you buy a $25 call option. That's going to give you the right to buy this stock, whatever stock it is. Let's say it's Starbucks. You have the right to buy it at $25 a share. Where do you want it to go? You want it to go up. Because if you can buy it at 25, where do you want to sell it? 50? 100? 150? Obviously, if Starbucks goes to 100 and you have the right to buy it at 25, you could exercise your right and you simply buy the stock at 25 by exercising that option and turn around and you could sell that stock 1 second later for 100 and you would make $75 per share. Not bad. But I want you to keep in mind, we do not exercise options. So what we're going to do with this option, we bought the option for a premium and we're going to sell it right back to the market. So when it becomes profitable and Starbucks goes up to 100, we don't exercise it because we don't want the stock. Remember, we don't want control. We don't want ownership. We want control. We don't want the ownership. I don't want stock. I want money. So how do I get the money? I bought the call for money. I sell the call back to the market. It's very liquid. I punch one button in a millisecond. It's sold as long as I do a market order, and it comes back, and guess what? That money hits my account. I have cash back in my brokerage account, and I would have at least $75 per share of profit when I bought the call, the right to buy it at 25, and it's selling at 100. There's $75 per share of real value there. So that is the call option. Now, the other option is the put. Now, this one threw me. Okay, this one threw me. When I started trading, I understood the call. It made sense to me. If I have the right to buy a stock at 25 and it goes up to 30, then I can buy it at 25, sell it at 30, make money. Okay, that made sense. The put did not make sense. So I'm going to try to make it really simple for you in this series of videos. By the time you're finished, you should really have a good grip of options. If you do not, you're going to contact me. Okay, and we're going to make sure that you do. The put. The put is the right to sell a stock. Now, why would you want a right to sell a stock? Well, remember, options are created specifically to reduce or eliminate risk. And yet brokers and people will tell you options are risky. That's because they don't understand them. They don't use them. A lot of brokers are not legally licensed to trade options. So they're not going to tell you that they're great because they don't want you to trade them and they're not really aware of how to use them. But they were created to protect you like insurance. So think of this. The put is the right to sell a stock. Well, just think of 2008 when the market's up high, or even back in 2000, and you have a stock, maybe it's one of your company stocks, and this stock has gone up greatly. It's gone up to a couple $100 a share. You are nervous because you know it's worth a lot of money, but maybe you can't take that stock out of your pension account or you can't sell it. So what do? You buy puts, and the put gives you the right to sell the stock at a higher price. So if you have a $100 stock and you buy a $100 put, you're going to pay a little premium, like an insurance premium, and you've just bought insurance on that stock. If the stock goes down from 100 to 50, you have the right to sell it at 100. So what happens is the put will go up in value as the stock goes down to offset the loss of your stock. So it is insurance. I'll make this clear for you in a few minutes, but understand there's two ways you can use a put. Number one is for the insurance to protect your stocks in the market against downfalls, which is a smart way to protect. It's called the protective put. You buy the put to protect your stock. The other way is you don't own the stock. You're just thinking that this stock is going to go down. So if you buy a put on the stock and the stock goes down, you actually make money. You can sell that put right back to the market very quickly, and you get the cash. So it's pretty much thinking that this stock has gone up so much, I think it's going down, or there's negative news. Good example is I just recently did 3 trades on the oil spill with British Petroleum and Transocean. Now, when this big oil spill hit in the Gulf, BP started dropping. Well, I didn't own BP, but I see that they're destroying the ocean. They have no fix. They're going to be sued. They're going to be hit with regulations, and the stock started to drop. What did I do? I bought a put. Okay, I bought a put, and each dollar that stock went down, I made money. I made good money, and that is what we want to do. So when you hear bad news, you want to buy the put to profit on the downside to the markets. 9/11, a lot of people were buying puts on the airlines. Okay, negative stuff happens, and it's going to happen. Keep in mind, at least you want to protect yourself against losing money, because 9/11, a lot of people got wiped out. You want to at least have protection on with puts, but if you're not going to do that, and you want to at least, make some money in the market based on the news, you can do so. Okay, it's up to you, but I just want you to know you need to at least have protection. So puts go down, and notice how the market goes down faster than it goes up. That's critical to understand. Now, because you're buying an option or a contract, it is control. You don't own it. It's going to expire. It's going to expire at some point in the future. And that depends on what option you buy. But options expiration date is the 3rd Friday of every month. Technically, it's the 3rd Saturday, but the market's closed on Saturday, so we'll just call it the 3rd Friday of the month. By close of market, the 3rd Friday of every month, options expire. So currently, we're in May, okay, and options will expire. If I own May options, they're expiring next Friday. So if today's the 13th, and next Friday's the 20th, so what happens is my option, if I owned May options, I only have about a week left for them to do something, otherwise they melt away like an ice cube. You don't buy short-term options unless you really get good and you understand how to do that, okay? And join our chat room, and I'll show you things that I do with that. It is free. Join our chat room, our free chat room anyway. I'm in there often, and you can see how I do short-term options, but ultimately we're going to buy some time, okay? We're going to buy time so we can give ourselves a chance and have the stock have a chance to play out whatever the scenario is that we want to trade. So, 3rd Friday of every month is expiration date. So May 3rd Friday, June 3rd Friday, July 3rd Friday, way out to 2012, January of 2012 3rd Friday. So we want to make sure we're out of our position long before that if we're going to have options expiration occur, because we want to make sure we're moving our money into the following months. We don't want it to melt against us. Here's the options expiration calendar, and you can get these for free at cboe.com, the Chicago Board of Options Exchange. But it just shows you here clearly that we have the calendar, and here's the options expiration for January. And here's February the 20th. And we got March So this little diamond here is your options expiration. You should really have this on your desk so you always are aware of your month's expiration. And then the other colored things, you can look at what those are with the Chicago Board of Options Exchange when you get the calendar. They have a color-coded calendar for you to look at. The key thing I want you to focus on is that green diamond, which is your expiration date. Very critical. Now remember, there's two sides of the coin. There's the buyer of options and the seller of options. If you're buying any option, you are paying money out of your brokerage account. If you're paying money out of your brokerage account, you are buying something. That gives you the right to do something. If I buy a Starbucks call, I have the right to buy the stock at a certain price. Well, guess what? I don't have to buy it. I just paid for the right to buy it. So I can do that, or I can sell my option, or I can do nothing and let the option expire. I have total choice because I paid. However, the seller of that option to me, whoever sold it to me, the market maker, whoever it is that's selling that option, they receive my premium. They make money. And if they make money, they are taking on an obligation. Okay, they are taking on an obligation to deliver. And we'll talk more about that. Just remember, buyers have rights and sellers have obligations. So really you have more choice when you're buying and you have less choice when you're selling. But you'll find that there's higher probabilities in selling options but less return. And then buying options, there's higher returns but less probabilities at times. We're going to get you down to understanding what creates the probability, and that really comes up in the charting and the news and the research on your stocks, and then you pick the option, the strike, the call, whatever it is, and you make the trade. Okay? So probability can be greatly enhanced by your homework. So this is the end of video 2. I'm sorry, the end of video 1 actually, and this is the end of video 1, and I hope you enjoyed it. Now, I encourage you to watch this a couple times. Make sure you understand it. If you do have questions, please jot those down. Send me any questions that you do have, and just, keep in touch, because if something is missing, if something's not coming together for you, definitely let me know, Vincent Serene Investor, and I'll fill in those details for you, okay? So I hope you enjoyed it, and get ready for video 2, and we'll see you very soon.